Well, it's going to be, it's always hard to talk about pipeline in equity capital markets transactions. Our pipelines are very robust. On M&A, our pipelines are almost double what they were a year ago, and
Wow.
we see a lot of potential activity. I'm somewhat cautious on, say, IPOs and on the equity capital markets because the markets are going through a bout of volatility here, and it's difficult to get deals done when the markets are jumping around like they are right now. January's been very volatile. The VIX is expanding. So yet we'll get through this, and I'm optimistic for the year in banking.
On that note, let me ask you about the Fed. And, as somebody in the financial sector, do you think their tightening is appropriate? What would you like to see, and what do you think it will further do to markets?
NATO
Well, the Fed is clear. I think the real question is the Fed going to change its plan here? And I don't think it will. I think everyone's waiting for this conference, what's going to happen this afternoon. I think what's going to happen is going to be nothing in terms of what is expected. The Fed has said that they're going to tighten, and the Fed has said that they're going to roll off the balance sheet. Now, if there's any any words that make that more dovish or more hawkish, the markets will react. My personal belief is not going to be anything said today that's going to change what was put into place as a plan, just about a month ago. So we're not going to see much. But I'll tell you, Kelly, where I think the market is missing a little bit or not taking into account is what's going on in Eastern Europe, or as Putin would like to say, Western Russia in Ukraine. And I have to tell you, I think that
so here we
that could end up, depending on how it plays out, but I, in my mind, see where oil could be significantly higher and the dollar could be significantly higher at the same time. And markets wouldn't like that. I'll just say I can cut through all the economic stuff for you here. Just say markets aren't going to like that.
No, and
if that happens,
the public wouldn't.
And I think.
Yeah, go ahead.
Well, I just feel that the markets are not fully pricing in that risk of some conflict in the Ukraine.
Well, and you're right. As much as we've been obsessing about the Fed, we have seen markets moving on a lot of these headlines, even just this past half an hour. It's relentless on that front. And if you're right about the impact, of course, that would be doubly significant. Ron, we'll leave it there. It's always great.
And that's why I will say to you, Kelly, even though we just had a record year and we see volumes and activity at very high levels, as it relates to the market in general, I'm cautious here. And I think that there's more downside risk for the next few weeks. For sure. I don't think we've seen the lows in 2022 of this market. So, keep the faith, but be cautious.
So the Fed comes out and
very interesting. A bit of a warning. Ron, thank you. Like we said, it's great to have you here. Ron Kraszewski is the CEO and the chairman of Stifel. Up next, gold, by the way, outperforming this year, maybe because of everything he was just talking about. We'll talk to the CEO of one of the biggest crypto exchanges about this reversal of fortune right after this.
If the Fed comes out and gives you, 4 to 5 rate hikes, but also lays out a timeline for balance sheet runoff that is anything sooner than
GRPN Groupon getting another spike here, 28.49. Golf Romeo Papa, November, GRPN. Groupon shares now up 25%. Bloomberg reported earlier that payments firm SumUp was seeking funding at a $22 billion valuation. Groupon holding more than a 10% stake, reportedly in SumUp. Groupon shares hitting 28.41 at the high, up 26% now. Golf Romeo Papa November GRPN. 10 minutes, less than 10 minutes to the Fed rate decision.
Welcome back, everybody. Crypto seeing a bit of a rebound this week with Bitcoin and Ether up about 8%, but they're still down big this year. Joining me now is FTX US President Brett Harrison. Brett, welcome. Big fundraising round. What's the valuation now?
442 before you can blink. So I'm going to look for those. The 442 strikes to the long side. If we get the downward action, right? If you get downward movement, and I end up going with puts, depending on what they say, I'll probably be at the 438 strike. Okay, that's kind of what I'm thinking. All right, so you guys understand the strike prices and the expiration dates I'm looking for. I will preface this by making every single one of you well aware.
Already put in the lows.
It's very difficult to say. You know, Bitcoin and crypto in general are very volatile assets still. I think until there's more institutional money coming into crypto, we're going to continue to see markets be somewhat unstable in terms of their volatility, which means along with those record-breaking highs, we're going to also see low downturns as well. It's difficult to know where this ends, but it's not the end in terms of crypto. This is not some long crypto winter. Again, I think all of the people building and creating new companies, technology in this space is going to result in some turnarounds. And when exactly it's going to happen is very difficult to predict.
Do you think the Fed is a factor in the sell-off here?
I think that when the Fed is making announcements and it's going to affect, for example, global equity, global futures markets, and there's just general negative indications for the market as a whole, or general risk-off attitudes on the market as a whole, naturally crypto is going to be affected. If you think about how much money has come into crypto from an allocation perspective, when there's such a larger percentage of crypto in large funds portfolios, whether that's big trading firms, big hedge funds, family offices, that naturally when we see these kinds of depressions, it's going to end up affecting crypto in kind as well. And so it's all becoming more correlated as crypto becomes a more highly traded asset in this market space.
Are you worried about any of the yield staking that's been going on as we've seen the assets under pressure?
It's hard to say. I think there is a pretty big diverse asset pool in crypto, and no two coins are exactly created equal in terms of the kinds of opportunities they provide for things like yield. And I don't think we can say definitively that this is something particularly to worry about.
All right. Well, so much happening in the space, Brett, and we have about 5 minutes till we hear from the Fed itself. So we'll be watching all asset classes, crypto included, and we thank you for joining us today. Brett Harrison is the president of FTX US. That does it, everybody, for the show. Power Lunch is going to pick up full Fed coverage. The decision just moments away, right after a quick break. Stay right there.
Five minutes to the Fed rate decision.
So that's expected, unless for some ungodly reason they raise rates now, but you'll see 0.25 versus 0.25. That means nothing. What else is said?
Yep, and then remember too, guys, sometimes the first move is usually the wrong move. First move is usually the wrong move. Not all the time. It depends on what's said, but a lot of times you'll get like the announcement comes out and like the first words that the algorithms pick up from the announcement report might be bearish. And then as you get deeper into the context of the announcement, the computer shifts depending on what's being read. All right. So we got a couple of minutes here, folks. We got a couple of minutes. Just stay calm, guys. Stay calm. Stay calm. All right. this is, yes, the markets have the potential to move in a big way, right? Markets have potential to move in a big way. All right. Sorry, guys, just reading millions of messages. I will tell you guys this now, guys. After the 2 o'clock announcement comes out, I most likely will not be answering questions because I'm going to be trying to sift through the Fed announcement and then try to get myself into a trade if I think there's a trade there to be had with us. All right. So we got about 4 minutes to go, about 3.5 minutes to go. And don't forget, don't feel rushed.
Good afternoon and welcome to Power Lunch, everybody. I'm Tyler Matheson along with Kelly Evans. We are just a couple of minutes away from the release of the Fed's statement. The central bank expected once again to signal that it is ready to hike interest rates at its March meeting. Before we get to our panel of experts, let's give you a base mark check on the markets right now. There you see the Dow Industrials, they're up 322,
2
or
minutes
about
to
1%.
the Fed rate decision.
The S&P 500 higher in percentage terms by 1 2/3% at 44.27. And just so you're record keeping, as you're taking notes here, NASDAQ up 2.5% at 13,881. How about the 10-year yield? Everybody's watching that one lately, and it has been right around where it's been for the past couple of days, 1.781, down just a few thousandths of a percent.
So there's your pre-Fed state of play.
There you go.
Where will we be at 2:01, 2:15, 2:30, 3 p.m. the rest of the year? Jim Karen is Global Fixed Income Portfolio Manager at Morgan Stanley Investment Management. He's on our panel today, along with Mona Mahajan, Senior Investment Strategist at Edward Jones, and David Kelly, Chief Global Market Strategist at JP Morgan Asset Management. Welcome, one and all. David Kelly, what are your expectations?
3 things. I think the Fed will, first of all, acknowledge that the Omicron variant
1 minute
has
to
caused
the
some
FOMC
uncertainty and
rate
some drag in the economy in the
decision.
first quarter. Second, I think they're going to express confidence that the economy is going to be strong in 2022 with very low unemployment and, frankly, inflation higher than they want. But third, I think they're going to talk about, taking it, they're going to give a clear indication they will raise rates starting in March. So I expect something in the wording will say, okay, we're ready. Final warning here, we're going to raise rates, but I think they'll do it steadily over the course of this year. I don't think they want to overreact.
30 seconds.
Mona, what about you? What is the most important thing you're watching for?
Yeah, look, the market has done a little bit of work for the Fed. We've seen yields move higher. We've certainly seen markets now price in 4, maybe 5 rate hikes this year. We've seen expectations for quantitative tightening starting as soon as July. So really what we're watching is, can the Fed now do anything that is slightly more hawkish than what the market is already expecting? So the probability of a hawkish surprise may have decreased as market expectations have ratcheted higher. That being said, we do expect Jerome Powell to talk about a March rate hike, 4 rate hikes this year,
voted 9-0 for the Fed
by March, and potentially start of QT as well.
Will complete
But all
monthly
in line
bond
thus
buying
far with market
taper
expectations.
in early March.
Mona, we're going to interrupt right now and go to Steve Leisman with the Fed decision.
U.S. economy continued to improve, but pandemic
Tyler, thank you very much. The Federal Reserve leaves interest rates unchanged, but it says in its statement the committee expects it will, quote,
inflation levels
soon
remain
be
elevated
appropriate to raise the target range for the federal funds rate. The statement said inflation is well
Fed will
above
adjust monetary
2%.
policy stance
now, the
as
Fed continues
appropriate.
to taper asset purchases.
Balance sheet
One more
reduction will
round
follow
it will
a
make
rate rise.
in February, and the statement
Balance
says
sheet
it will
reduction
end
to
the
be
asset
predictable.
purchases in early March. The statement deletes a section saying the Fed will use its full range of tools to support the economy. Notes the sharp rise in COVID cases continues to affect the economy, but says overall economic activity and employment have continued to strengthen. Job gains, it says, have been solid. Supply and demand imbalances, mostly related from the pandemic, are contributing to inflation. The path of the economy, keeping a line from prior statements, continues to depend on the path of the virus. Risk to the economic outlook, the statement says, remain. The committee says it's prepared to adjust its monetary policy stance as appropriate. Now, it makes no mention of the balance sheet, but it does have its new long-run statement out, which I don't see a whole lot of changes, but I want to note one line from the statement where it says the primary means of adjusting policy is through the Fed funds rate. That has been the policy of the Federal Reserve, and it remains the policy of the Federal Reserve. No mention, Kelly, of any balance sheet adjustment in this statement. It suggests that maybe the Fed is not prepared to announce or has come to a decision about what to do with the balance sheet. But that one statement from the long-run policy says that the Fed funds rate will be the primary means that the Fed will address policy and the economy.
All right, Steve, thank you very much. Let's get some quick response from our panel. Bob Bassani, Rick Santelli are also joining us. Rick, you want to just give us a quick thought on rates here?
Yeah, you know, rates, the two-year note dropped a little bit with regard to rates, and the curve was steepening. But now rates are going up. You're going up in 2s, you're going up in 10s, you're going up in 30s. It makes sense.
S&P futures,
you know, when it comes to interest rates, I continue to stress the Fed hasn't raised anything. They haven't stopped buying anything, and they haven't shrunk anything. Okay? So basically, they're putting the market through this ordeal for months and months and months, generating all this volatility. They should stop buying, they should slowly start raising, and they should do it rather quickly. They're not going to do that. If you want me to comment on what the Fed is saying, I basically think that they're not necessarily taking the route that I or many people that trade the markets would take. They're going it alone. But I would say one thing, quantitative tightening or the lack of quantitative easing or shrinking the balance sheet most likely will be the most painful. Because if the economy can't stand going from 0.25 to 1 to 1.25 by year end, there's a whole lot more wrong with the economy than the fleeting effects of Omicron.
And there's the 10-year above 1.8% there. So let me turn to Jim Karen. Jim, just as you said, the Fed will likely signal a rate hike in March, and indeed they basically have. But you said more important is any hint or signal on the balance sheet operation. So what do you make of this so far?
So thank you for having me on your show, Kelly. Look, I think this is a clear lack of clarity, and it's probably by design from the Fed. They've done what they're supposed to do, at least what the markets thought. They signaled a 25 basis point rate hike, and the rest of their statement was very, very balanced. What's top of mind for the market is what the Fed does with their balance sheet. And, you know, just like Rick Santelli was saying, that, you know, this is really going to be the pain point. Any shrinking of the balance sheet, maybe that's the second half of this year. I think that's something that we need to focus on and we need to figure out more. So if we think about how the Fed is going to operate in this environment, it's almost impossible to me that they just use the interest rate policy as their primary tool. I mean, yes, it will be their primary tool, but they have to use that in complement with the balance sheet. So effectively, if we're in a situation where we see that, you know, inflation continues to stay high and the Fed has to act more, they've got to lean on the balance sheet. Otherwise, all they're going to do is raise front-end rates and flatten the yield curve. And I don't think that's the outcome that they effectively want.
And raising longer-term rates is really what you can do through balance sheet maneuvers. Let's go to Bob Pisani for a look at how stocks have reacted to this non-raising of rates right now in the statement. And Bob, it does look like markets like what they heard.
Yeah, and I'll tell you why. No balance sheet adjustment mentioned there. So there are people down here. Remember, bulls down here.
I like
they're
that there's
concerned about
no
the stock
mention
market.
Of the balance sheet
they were trying to figure out how can Powell
dovish.
make some comment to
But
turn down the
everything else is
temperature,
very, very
but
vague.
still sound hawkish because he has to. And this sounds like a good way to have done it. The hikes are coming in March. They're going to asset price buying is going to end. We know that, but no mention of the balance sheet adjustment is bullish for stocks overall. It turns the temperature down just a little bit. And in a way, this is sort of the most boring of the meetings coming. The more interesting one's going to come in March. They're going to give guidance in March. They're going to have to provide some outlook on the economy in the second half of the year. And they're going to have to justify their more hawkish stance. So turning down the temperature a little bit, which I think is what's happening here, is why the market's reacting. We're seeing things move to the upside here. So we'll keep an eye on this, but I really like the fact that they didn't leave any balance sheet comment in there, and I think that's what's moving things. And, of course, the Fed fund comment, really very important as well.
I'll be very curious now, Steve, what Chair Powell does, who will obviously be asked all about the balance sheet at 2:30, and does he go that route, or does he try to stay, try to keep the lack of clarity that Jim was describing? What else can you add here, Steve?
Well, I just want to say there was, I think, never any expectation, at least on my part and on any of the people who I've spoken to, that the Fed was going to mention the balance sheet in this statement. I just made that comment in case anybody was looking for it. But if you're buying stocks now because the Fed did not mention the balance sheet in the statement, there is no, what's the word I'm looking for, break it all from this possibility, because I think it's going to be mentioned by Powell. The Fed has not decided yet, I think, upon the balance sheet strategy here. And that is to come. The expectation we have in our Fed surveys that will come in the summer, the Fed is definitely going to get 1 or 2 rate hikes underneath its belt, and then it will turn to actual, we believe, balance sheet reduction. It could, of course, come off that, but I just want to be clear, the fact that it wasn't in the statement is not a double sign of anything.
That $20 price
Very interesting.
objective.
But let me ask quickly, Steve, to you, and then I want to turn to David. Quickly to you. The main way the Fed could impact or influence longer-term interest rates would be through balance sheet activities. Am I right about that, or mostly right, or kind of right? Do I get a C-?
I always give you an A, Tyler, if not just for effort, but also for acumen. I think that is what will happen is a combination.
It's a very vague
and this is the key. And I'm relying on guys like Fed Governor Waller and Bullard on this.
So this is kind of like
what it will do is raise interest rates on the short end, and then through some balance sheet activities and maneuvers, try to offset the flattening aspects of that through balance sheet reduction. It's a combination, Tyler. It's not one or the other. And because it's so complicated, I think it was Kelly who was saying earlier, we just don't know as much about the impact of balance sheet reduction, either on the economy or on markets. The Fed will tread very carefully here, and it will. I believe it will do some. That's my belief. That's the belief of the market. But do so in a very measured way. The expectation in the CNBC Fed survey is $380 billion to come off the balance sheet this year. We'll see if that's high, low, or about right.
All right, let's go to David Kelly. I first want to get your reaction to what has transpired here, what the Fed has said in its statement, the conversation. That's number one. And then second, I want you to drill down on something in my notes that you said, and that is that the classic mistake of monetary policy is to act too harshly, too aggressively, too late, which presumes that you believe that the Fed is too late and now is playing catch up. But overall reaction and then that specific thought.
Well, first of all, I think the statement was exactly on target. I think the Fed is setting people up for the expectation that they'll raise rates 4 times this year. And I think in Chairman Powell's comments, you probably will start talking about the balance sheet. But they'll want to give themselves a little flexibility on the balance sheet, because there is no point in raising short-term rates to slow the economy, to control inflation, if you don't also intend to raise long-term rates. So they could always reduce the balance sheet more aggressively later this year if they felt that that long rates weren't going up enough. But yes, they absolutely shouldn't overreact right now. Monetary policy is like driving on ice. And if you find yourself slipping over to the left, I mean, that's fine. But if you jerk on that steering wheel to try to get over to the other side, you're just going to spin out of control. They should have been tighter all along. Over the last 14 years, they should have been tighter. They've caused asset bubbles. But they can't fix that now. They've just got to direct monetary policy in a steady way of trying to get back to normal, positive real interest rates, and just hope that the economy can hold it together as they do that.
Well, last cycle, people might say was a different story, David, but this time, absolutely, you might be right. Let's go back to Jim Caron. Jim, can you clarify a little bit the importance of the balance sheet here? So the Fed has told us in the statement they think the Fed funds rate is the primary mechanism here. That's how they're going to conduct monetary policy. They're trying to kind of push people off of obsessing over the balance sheet. What is the impact of all of this going to be, of quantitative tightening, when it does happen, and why are they emphasizing the policy rate so much?
Yeah, so one of the things that I think that the market's taking away from this is that there was a fear factor being built up that the Fed would be overreacting to the current inflation environment right now. And we're not seeing that. The statement was very, very, was very, very, I guess, somewhat tame. But look, I mean, the balance sheet is the absolute critical policy measure for this year. We've priced in 4 rate hikes this year. That's probably what we're going to get. That's yesterday's news. The big issue here is how the Fed uses their balance sheet, and also what level of inflation does the Fed feel comfortable with? Are they going to stick with their 2.6, 2.7% core PCE target by the end of the year, or they claim victory at 3%? Is there a level that the Fed overreacts to with inflation? If it does, then the fear is that the Fed starts to go much, much more aggressively. So the balance sheet is really the area that I think that the Fed can actually start to fine tune at least the back end of the curve, because as Tyler was commenting on, that's the only real way that they can keep back end rates higher. There's still a lot of money in the system. There's still a lot of QE. If all they do is push front end rates up and keep back end yields really, really low, that sends the wrong signal to the market by having a very flat or even possibly inverted yield curve by the end of all this, but say by 2023 or 2024. So there needs to be some, complementary moves here. Maybe they do less rate hikes and they do more with the balance sheet. But this is a discussion for the second half of the year. But we're going to start having this discussion early right now, because it's going to matter a lot for asset prices.
I think it was Rick who mentioned the possibility of an inverted yield curve just a few minutes ago. Mona, let me turn to you and get you to react to what David said there about interest rates being too low for too long. 40 years was I think the number he said. That it feels a little bit like what David is saying is that low interest rates are a kind of financial crack cocaine, that is. And now we are being titrated off of that. Can the economy deal with that? Can the markets deal with that? And how slow or how fast will the Fed need to go as it calibrates this titration away from financial crack?
Yeah, absolutely. Look, we're already getting signals from the market that as the Fed raises rates, those more speculative assets, the ones that were highest valued from a valuation perspective, they are getting hit hardest and hit first. And we expect that phenomena to continue as this Fed rate hiking cycle progresses. Keep in mind, historically, when the Fed tightens rates, we do get valuation compression across markets, but it is the highest valuation parts of the market that do get hit hardest. So we certainly expect that phenomena to continue this year. More broadly, though, when we step back and look at where we are in this economic cycle, we still, very much feel that we are mid-cycle in this economic expansion post-pandemic. Keep in mind, we have a pretty healthy consumer. We have earnings growth looking 7 to 9% range. We have economic growth still above trend, 4%. And so can this economy handle 4 Fed rate hikes this year? We certainly think that will not derail the underlying expansion. Now, as we head to 2023, perhaps 2024, economic growth will return back in line with trend. And that's when we really have to start thinking about where we want to be in terms of inflation, interest rates, and what level of the yield curve and yields can this economy handle. But certainly for 2022, still very much mid-cycle, still very much early days in this Fed rate hiking cycle. And from a market perspective, that also portends pretty well. Perhaps we will get a more value cyclical bent early on. But we think down the road, when growth slows, growth sectors will return back into favor as well. So certainly we favor holding a balanced portfolio here, using volatility as opportunities, because we are not near the end of this cycle yet.
As stocks have edged higher in the past 15 minutes or so, rates higher, although, 10 years trying to hold that 1.8% level. Rick, what would you say as we await the press conference in the next 15 minutes?
Well, first of all, rates, if you blur your eyes, aren't so far away from where they were before the statement. What I would say is I think the Fed needs to put guidance under the microscope. I personally think that their guidance is horrible. And I don't mean that they're communicating poorly. 97. I think it's like never ripping off the Band-Aid. Blah, blah, blah. We're going to blah, blah, blah. We're going to blah, blah, blah way down the road. Guidance. We should be more surprising. We should do things in an orderly manner, but not necessarily so much guidance. Maybe throw a 50 basis point tightening in there. Remember, no central bank I know of has ever had symmetry between easing and tightening. It's always asymmetric. They always want to ease. They always want to run away from tightening. We didn't even normalize after the credit crisis. Their balance sheet's too big. If anything happens in the next couple of years, we have very few choices to make. They need to start things sooner, and they need to explain less, more action,
Okay,
less
this
words.
is not a
Believe
very
me,
big
the markets
move
need to
for
be
the
able to
markets
handle
at
it.
all.
All right, last word goes to Steve.
Right
Steve
now, on
Leisman.
the back of this announcement.
Yes, I want to
It's
tell
actually
you
a
there
very
is a
small
statement of
move
principles
compared
that
to
the
what
Federal
implied
Reserve released
volatility on all your
about
options
reducing
were
the size of
indicating.
the Fed's balance sheet
Such a
that was
very
put out as a
small
separate
move so
document.
far.
It said the committee
It's a very
intends to
vague statement.
reduce the Federal Reserve
I
security
think,
over time
people are really
in a
going to
predictable
rely
manner,
on what
primarily by adjusting
House,
the amounts reinvested of principal
conference is at
payments.
2:30.
It says over time
I
the
think a lot of
committee
people are
intends to
gonna rely on
maintain
that.
securities holdings and amounts needed to implement monetary policy. It also says that it will do so after the process of raising the target rate has begun. So there is a statement of principles here on the balance sheet, and it's prepared to adjust any of the details of the approach in light of economic and financial development. So the Federal Reserve has, in fact, taken the initial steps here about reducing the balance sheet by putting out a statement of principles.
All right, very interesting. Steve Leisman, thank you very much. And thanks to our panel. We'll see some of you a little bit later, but we appreciate all of your contributions today. We thank you.
Coming up, more analysis of the Fed. Former Fed Governor Robert Heller joins us. He's been an outspoken critic of the central bank, warning that they are behind the curve. We'll ask him what he expects to hear from Chair Powell at the press conference, which starts at 2:30 Eastern Time, 13 minutes away.
All right, Mr. Powell's going to have a lot of splaining to do at 2:30. Markets are not very, very different from before the announcement. We were 441. Now we're 440. So the markets really have not moved very much. This guy's going to get asked some pretty tough questions. He's going to get asked a lot of questions about balance sheet runoff. He'll get asked questions about, is it still 3 rate hikes? Is it going to be 4 or 5? Still very vague on their statement. So I expect reporters to ask him very detailed questions.
Welcome back, everybody. Quick look at the market shows we're slightly below the levels that we were on stocks into the Fed decision 20 minutes ago. So we're still definitely green. Dow's up 217 points, or 0.2%. NASDAQ up a little bit more than 2% now, so we are off the highs. Let's get to Bob Bassani with more color. He's down at the NYSE. Bob?
And Kelly, I think the market rose initially on the basic read on the FOM statement that it was sort of in line with the current narrative. So the current narrative is we're going to get a rate hike beginning in March. It's going to be a rate hike every other meeting, likely a quarter point. And of course, they're going to end up with the asset price buying ending very soon. And I think that's why we initially rose. I think the important thing, so the status quo is intact. I think what Steve Leisman said about the statement of principles on the balance sheet are very important, even though that sounded very mild. As he was announcing that, we came off of the highs and are now slightly below where we were just prior to the Fed. So I think at the presser, Mr. Powell is going to get a lot of questions about that balance sheet statement and a little bit more about what's going on there, because that's obviously a bit of concern for the market. Kelly, back to you.
All right, I'll pick it up, Bob. Thank you very much. Bob Pisani, our next guest, says today's Fed move is disappointing and leaves the Fed further behind the curve. Joining us now is Robert Heller, former Federal Reserve Governor. Mr. Heller, thank you very much for joining us once again. We're always happy to have you with us.
Good to see you, Tyler.
Fantastic. You wish the Fed had moved quicker. You say we've met our basic goal of full employment and economic growth, and the only thing the Fed has to worry about is inflation, so get about it. You'd like to have seen them raise rates now. Why do you think they didn't?
I have no idea. They have no backbone. They have no gumption. It's not a Paul Volcker who is in charge right now. And I finally said just a little while ago, the Fed needs more action and less words.
And how far behind the curve do you think they are, number one, and how much harsher do you think they will have to be going forward to catch up to where you think they ought to be? Is a quarter point, is 4 quarter points going to do it?
No. The Fed funds rate should be right now around 2% or a little bit higher. The long-term interest rates should be reflecting the high inflation that we have at the present time, and they are nowhere near there because the Federal Reserve is still stimulating the bond market by buying mortgage-backed securities, which is hardly needed at a time when housing prices are going through the roof in double digits.
Yes, and we've flooded. I take your point that the system has been flooded with money, not just by this Fed, but by prior Feds, as they engage in quantitative easing, which is basically the buying for cash of government and mortgage-backed securities. We've got an expanded money supply, right?
Absolutely. During 2020 and 21, money supply soared 25% per year. That's an incredible amount of money to put into an economy. Never mind the virus. But where does the productive capacity come from to deal with that enormous increase in demand that such an increase in the money supply generates? And we see 21 reflected money supply inflation data, 25% per year in the stock market. That's an incredible amount of money to put into an economy. Never mind the virus, then it wasn't produced. Where does the productive capacity come from and we deal with that enormous increase in demand that such an increase in the money supply generates? And we see 21 reflected money supply inflation data, 25% per year in the stock market. That's an incredible amount of money to put into an economy.
What about
never mind the virus, then it wasn't produced. Where does the productive capacity come from and we deal with that enormous increase in demand that such an increase in the money supply generates? And we see 21 reflected money supply inflation data, 25% per year in the stock market. That's an incredible amount of money to put into an economy. Never mind the virus, then it wasn't produced. Where does the productive capacity come from and we deal with that enormous increase in demand that such an increase in the money supply generates? And we see 21 reflected money supply inflation data, 25% per year in the stock market. That's an incredible amount of money to put into an economy. Never mind the virus, then it wasn't produced. Where does the productive capacity come from and we deal with that enormous increase in demand that such an increase in the money supply generates? And we see 21 reflected money supply inflation data, 25% per year in the stock market. That's an incredible amount of money to put into an economy. Never mind the virus, virus at any point. But where does the production capacity come from? And where deal with that enormous increase in demand that such an increase in money supply generates? And we see 21 money supply absorbed 25% per year. That's an incredible amount of money supply to an economy. Never mind the virus at any point. But where does the production capacity come from? And where deal
AP reporting Los Angeles Council approved a measure to ban new oil wells.
No, I'm honestly not leaning. I'm honestly not leaning one way or the other. That statement, being as vague as it was done 100% by design. The Fed did that on purpose. They know that, every investor on the planet is waiting to hear what they have to say. And after the NASDAQ falls 14%, they're like, hey, let's, I think them being vague, I think that's actually more hawkish, because I feel like it's the Fed. The Fed is just scared to rip off the Band-Aid, but they want to. But the market freaked out, so they don't want to worry the markets even more, but them coming out, you really would have wanted them to.
Welcome back,
really
everybody. Fed Chair Powell's news conference is just minutes away. Stocks slightly off session highs. Well, they're off earlier session highs, but slightly off where we were going into the 2 p.m. decision. The yield on the 10-year now at 1.81%, so we'll call that creeping higher. Let's get some final thoughts from David Kelly of J.P. Morgan here. David, what are the most contentious issues to listen for now?
Well, I think the chair is going to take a fair amount of heat for the level of inflation, but he's got to hold his nerve here. I mean, a lot of this inflation was caused actually by fiscal policy, by all this fiscal stimulus last 2 years. It really wasn't about monetary stimulus, which has contributed to higher asset prices. And he's got to hold his nerve. The Fed needs to raise rates gradually because they need to normalize policy. But you can't normalize policy if the economy falls into recession. And I think one of the greatest risks here is he overreacts, the Fed overreacts, jacks up interest rates, that actually pushes the economy into recession, and then they'll never normalize the balance sheet or get rates back to where they need to be. So they've got to take it gradually, but he's going to get a fair amount of pushback, and he's just got to hold his nerve and keep delivering a steady message of we're going to gradually increase interest rates.
So then how do you react when you hear what Fed Governor Heller just said? They need more backbone. They need to have acted quicker. They need to do both things at once, walk and chew gum, adjust the balance sheet and interest rates. And when you hear Rick Santelli say, we need more action, less words.
I think the world would be much more interesting for Rick if we did get more action and less words. But in terms of policy, yes, of course they should have been tighter, but they need to adjust policy gradually. You just can't turn it on a dime because it just causes too much volatility and uncertain effects in the economy. All this works with long and variable lags. And the problem is the economy was very strong in the fourth quarter. We'll see that tomorrow. But it's also looking very weak in the first quarter. And there's lots of risks out there. You just don't want to take a full employment economy and slam the brakes on and hope that it keeps on growing, because it might not.
You can't have it both ways, David. You say they're behind the curve, but then
Coming
they
up,
can't.
Fed Chair Powell.
Yeah,
no,
absolutely. I can believe that somebody should have a proper diet without saying that somebody's just had a heart attack needs to go out and run a marathon.
They're not out there saying they're going to raise rates. They're not doing what Bill Ackman wanted to and go, coming out with a surprise 50-point rate hike.
Yeah. No, they shouldn't try and surprise markets. I think there are vulnerabilities in this economy. It's a weird economy because of what Omicron is doing, because of everything we've been through here. They need to gradually increase rates and just hope that everything else sort of smooths out here. We will pay a price in higher inflation for what's gone on in the last few years, and we'll just have to put up with it. But if they gradually get rates back to normal levels, I do think the long-term trends in the global economy, the U.S. economy, are fundamentally disinflationary. I think we will get back to lower inflation.
Here comes the chair.
To achieving the monetary policy goals that Congress has given us, maximum employment and price stability. Today, in support of these goals, the Federal Open Market Committee kept its policy interest rate near zero and stated its expectation that an increase in this rate would soon be appropriate. The committee also agreed to continue reducing its net asset purchases on the schedule we announced in December, bringing them to an end in early March. As I will explain, against a backdrop of elevated inflation and a strong labor market, our policy has been adapting to the evolving economic environment, and it will continue to do so.
Labor market, we will continue to adapt.
Economic activity expanded at a robust pace last year, reflecting progress on vaccinations and the reopening of the economy. Fiscal and monetary policy support and the healthy financial positions of households and businesses. Indeed, the economy has shown great strength and resilience in the face of the ongoing pandemic. The recent sharp rise in COVID cases associated with the Omicron variant will surely weigh on economic growth this quarter. High-frequency indicators point to reduced spending in COVID-sensitive sectors, such as travel and restaurants. And activity more broadly may also be affected as many workers are unable to report for work because of illness, quarantines, or caregiving needs. Fortunately, health experts are finding that the Omicron variant has not been as virulent as previous strains of the virus, and they expect that cases will drop off rapidly. If the wave passes quickly, the economic effects should as well, and we would see a return to strong growth. That said, the implications for the economy remain uncertain. And we have not lost sight of the fact that for many afflicted individuals and families, and for the healthcare workers on the front lines, the virus continues to cause great hardship.
Market has made remarkable progress.
The labor market has made remarkable progress, and by many measures is very strong. Job gains have been solid in recent months, averaging 365,000 per month over the past 3 months. Over the past year, payroll employment has risen by 6.4 million jobs. The unemployment rate has declined sharply, falling 2 percentage points over the past 6 months to reach 3.9% in December. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand remains historically strong.
Labor demand remains
With constraints on labor supply, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years.
Wages are rising at the fastest
While
pace
labor force
in many
participation
years.
has edged up, it remains subdued, in part reflecting the aging of the population and retirements. In addition, some who would otherwise be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. The current wave of the virus may well prolong these effects. Over time, there are good reasons to expect some further improvements in participation and employment. Inflation remains well above our longer-run goal of 2%. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, and we are attentive to the risks that persistent real wage growth in excess of productivity could put upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline over the course of the year. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. In addition, we believe that the best thing we can do to support continued labor market gains is to promote a long expansion, and that will require price stability. We're committed to our price stability goal. We will use our tools both to support the economy and a strong labor market, and to prevent higher inflation from becoming entrenched. And we'll be watching carefully to see whether the economy is evolving in line with expectations.
Powell says watching carefully to see if
the Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American
S&P
people.
futures pulling back.
As I noted, the committee left the target range for the federal funds rate unchanged and reaffirmed our plan, announced in December, to end asset purchases in early March. In light of the remarkable progress we've seen in the labor market and inflation that is well above our 2% longer-run goal,
Powell says the
economy no longer needs sustained high levels of monetary policy support. That is why we are phasing out our asset purchases and why we expect it will soon be appropriate to raise the target range for the federal funds rate. Of course, the economic outlook remains highly uncertain. Making appropriate monetary policy in this environment requires humility, recognizing that the economy evolves in unexpected ways. We'll need to be nimble so that we can respond to the full range of plausible outcomes. With this in mind, we will remain attentive to risks, including the risk that high inflation is more persistent than expected, and are prepared to respond as appropriate to achieve our goals.
To higher inflation.
To provide greater clarity about our approach for reducing the size of the Federal Reserve's balance sheet, today the committee issued a set of principles that will provide a foundation for our future decisions. These high-level principles clarify that the federal funds rate is our primary means of adjusting monetary policy, and that reducing our balance sheet will occur after the process of raising interest rates has begun. Reductions will occur over time in a predictable manner, primarily through adjustments to reinvestments, so that securities roll off our balance sheet. Over time, we intend to hold securities in the amounts needed for our ample reserves operating framework, and in the longer run, we envision holding primarily Treasury securities. Our decisions to reduce our balance sheet will be guided by our maximum employment and price stability goals. We're prepared to adjust any of the details of our approach to balance sheet management in light of economic and financial developments. The committee has not made decisions regarding the specific timing, pace, or other details of shrinking the balance sheet. And we will discuss these matters in upcoming meetings and provide additional information at the appropriate time. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. For the first question, we'll go to Chris Rugaber at the Associated Press.
Thanks, Michelle, and thank you, Chair Powell. So it's expected that the Fed will hike rates perhaps every other meeting, but certainly in the past, the Fed has hiked at every meeting. So I just wanted to ask, are rate hikes at consecutive meetings on the table this year? Is every meeting a live meeting? And on that note, would the Fed consider front-loading some of its rate hikes, even if it doesn't raise every meeting? Thank you.
Thanks. So as I referred to in my opening statement, it is not possible to predict with much confidence exactly what path for our policy rate is going to prove appropriate. And so at this time, we haven't made any decisions about the path of policy. And I stress again that we'll be humble and nimble. We're going to have to navigate cross currents and actually two-sided risks now. And I'll say also that we're going to be guided by the data. In fact, what I'll say is that we're going to be led by the incoming data and the evolving outlook. We'll try to communicate as clearly as possible, moving steadily and transparently. So more to your question, we know that the economy is in a very different place than it was when we began raising rates in 2015. Specifically, the economy is now much stronger.
Powell says we know the economy is
the
in a
labor
very
market is
different
far stronger. Inflation
place
is
to
running well above our
2015.
2% target, much higher than it was at that time.
Says
And these
differences will
differences
have
are likely to have
implications for the
important
pace
implications for the appropriate
of rate
pace of
hikes.
policy adjustments. Beyond that, we haven't made any
Beyond that,
decisions.
no decision has been made.
Thank you. Let's go to
As Chair
Victoria
Powell
Guida,
speaking
Politico.
now, following the Fed rate decision.
Hi, Chair Powell. I wanted to ask, you were talking about the health of the labor market, and I'm curious whether you would characterize where we're
S&P
at right now
futures
as
getting a
maximum
bounce here now,
employment, and also
44.18.
along those same lines, obviously rate hikes on the table this year. Do you think that the Fed can raise rates, bring inflation under control without hurting jobs and wages?
Sorry, just getting both parts of your question written down. So I would say, and this view is widely held on the committee, that both sides of the mandate are calling for us to move steadily away from the very highly accommodative policies we put in place during the challenging economic conditions that the economy faced earlier in the pandemic. And I would say that most FOMC participants agree that labor market
Powell
conditions
says-
are consistent with maximum employment in the sense of the highest level of employment that is consistent with price stability.
Labor market-
And that is my personal view. And again, very broad support on the committee for the
Is
judgment that it will
consistent
soon
with
be
maximum
appropriate to raise
employment.
the target range for the federal funds rate.
That is
The other
also
thing
my
is maximum
personal
employment
view.
will evolve over time and through the course of the business cycle. In the particular situation we're in now, it may well increase. The level of maximum of employment that's consistent with stable prices may increase, and we hope that it will as more people come back into the labor market, as participation gradually rises. And the
Powell
policy
said broad
path that
agreement
we're broadly
on
contemplating
FOMC will
would
soon be
supportive
time
of
to raise rates.
that outcome as well.
The level of maximum
So,
employment may increase as more
The thing about the
people
labor
return to
market
the
right
labor
now is
market.
that there are many millions of more job openings than there are unemployed people. So you ask whether we can
Powell says policy path
raise rates
we are
and move
contemplating
to less
would be
accommodative and even tight
supportive of
financial
that
conditions without
outcome.
hurting the labor market. I think there's quite a bit of room to raise interest
Says there
rates
is quite a
without
bit
threatening
of
the labor
room
market. This
to
is,
raise interest rates.
by so many measures, a historically tight labor market. Record levels of job openings, of quits. Wages are moving up at the highest pace they have in decades. If you look at surveys of workers, they find jobs plentiful. Look at surveys of companies, they find workers scarce. And all of those readings are at levels really that we haven't seen in a long time, and in some cases ever. So this is a very, very strong labor market, and my strong sense is that we can move rates up without having to severely undermine it. I also would point out that there are other forces at work this year which should also help bring down inflation. We hope, including improvement on the supply side, which will ultimately come. The timing and pace of that are uncertain. And also, fiscal policy is going to be less supportive of growth this year, not of the level of economic activity, but the fiscal impulse to growth will be significantly lower. So there are multiple forces which should be working over the course of the year for inflation to come down. We do realize that the timing and pace of that are highly uncertain, and that inflation has persisted longer than we thought. And of course, we're prepared to use our tools to assure that higher inflation does not become entrenched.
Thank you. Let's go to Nick Timrose at the Wall Street Journal.
Good afternoon, Chair Powell. Nick Timrose of the Wall Street Journal. I have a couple of questions on the balance sheet. The statement on the balance sheet today calls for significantly reducing your holdings. What does that mean? And then apart from moving sooner and faster to shrink the holdings, are there any other ways in which you and your colleagues are seriously thinking about recalibrating this process? And finally, how much disagreement is there around how you should use this tool, including active sales rather than passive sales, or changes in the composition of reinvestments? Thank you.
So I'm afraid to tell you that those are all great questions, and they're questions that the committee is just turning to now. So we had a discussion, as you know, at the last meeting, an introductory discussion of the balance sheet and a teeing up of the issues. At this meeting, we've gone through and carefully put together a set of principles at a high level And those are meant to guide the actual decisions we'll make about the pace and about all of the questions that you're asking. And I expect that this process will be something that we spend time on in coming meetings. I can't tell you how many, I can't tell you how long it will take, and then, at the appropriate time, we'll provide additional information. So the last cycle when we went through balance sheet issues, we did find that over the course of 2 or 3 meetings, for example, we did come to interesting and better answers, we thought. So we're just in that process now, and at the next meeting, we'll be turning to more of the details that you're asking about. I would say this: the balance sheet is much bigger. It has a shorter duration than the last time, and the economy is much stronger, and inflation is much higher. So, and I think that leads you to, and I've said this, being willing to move sooner than we did in the last time, and also perhaps faster. But beyond that, it's really not appropriate for me to speculate exactly what that would be. But I would point you to principle number 1, which is the committee views changes in the target rate for the federal funds rate as its primary means of adjusting the stance of monetary policy. So we do want the federal funds rate, we want to operationalize that, and we want the balance sheet to be declining in a predictable manner, and we want it to be declining primarily by adjusting reinvestments.
So if I could follow on that, raising rates and reducing the balance sheet both restrain the economy, both tighten monetary policy. How should we think about the relationship between the two? For example, how much passive runoff is equal to every 1/4 percentage point increase in your benchmark rate?
So again, we think of the balance sheet as moving in a predictable manner, sort of in the background, and that the active tool meeting to meeting is not both of them, it's the federal funds rate. There are rules of thumbs, I'm reluctant to land on one of them that equate this, and there's also an element of uncertainty around the balance sheet. I think we have a much better sense, frankly, of how rate increases affect financial conditions and hence economic conditions. Balance sheet is still a relatively new thing for the markets and for us, so we're less certain about that. So again, I think the pattern we'll follow is to arrive at a timing and a pace and composition and all those things, and then announce that with advance notice, and it will start in the background, and then we'll look to have that just running in the background and have the interest rates again be the active tool of monetary policy. That's at least the plan. I can't tell you much more about any of the very good issues about size, pace, composition, those sorts of things. We'll be turning to all of those at coming meetings.
Thank you.
Thanks. Now we'll go to Neil Irwin.
Thank you, Chair Powell. It's Neil Irwin from Axios. Glad to be back. Sir, I was wondering if the volatility we've seen in financial markets in the last few weeks strikes you as anything alarming or that might affect the trajectory of policy. Conversely, to the degree that financial conditions have tightened some, might that be desirable in some ways in achieving your tightening goals?
So, as you know, the ultimate focus that we have is on the real economy, maximum employment and price stability, and financial conditions matter to the extent that they have implications for achieving the dual mandate. And you also know that we look at broader financial conditions, not one or two things, one or two markets. And what we're always asking ourselves is, are we seeing changes that are both persistent and material enough that of a change in financial conditions that they are inconsistent with the achievement of our goals? So that's how we're looking at that. And I don't want to comment on today's financial conditions broadly, but we're not looking at any one market or so. So that's how we're thinking. In terms of what we've seen, I would say this. We said at our last meeting, we published a summary of economic projections, the median participant expected 3 rate increases this year. And, it's 6 weeks, 7 weeks later now. And you have seen that our communication channel with the markets is working. Markets are now pricing in a number of rate increases. Surveys show that market participants are expecting a balance sheet runoff to begin, at the appropriate time, sometime later this year, perhaps. We haven't made that decision yet. So we feel like the communications we have with market participants and with the general public are working, and that financial conditions are reflecting in advance the decisions that we make. And monetary policy works significantly through expectations, so that in and of itself is appropriate.
Thank you. Let's go to Howard Schneider.
For a year, hi, thanks, Chair Powell. Howard Schneider with Reuters. So for a year now, the statements reference the benchmarks for this initial interest rate increase. Now that we're approaching that moment, what are the benchmarks going to be for subsequent rate increases? I know you can't stipulate the path, but how should we think about the criteria for the next step and the next step?
Well, you're right. We haven't gotten to that point yet. We haven't made a decision yet, and we'll make that decision at the March meeting. We'll make a decision whether to raise the federal funds rate. I would say that the committee is of a mind to raise the federal funds rate at the March meeting, assuming that conditions are appropriate for doing so. We have our eyes on the risks, particularly around the world, but we do expect some softening in the economy from Omicron, but we think that should be temporary, and we think that the underlying strength of the economy should show through fairly quickly after that.
If I could follow, just on a related question, the December SEPs had this copacetic sort of set of circumstances where inflation comes down without the federal funds rate ever getting over the estimate of neutral. Given developments since then, do you still think that's a credible narrative for the ultimate path of policy?
The path is highly uncertain, and that we're committed to using our tools to make sure that inflation, high inflation that we're seeing, does not become entrenched. So a number of factors would be, it's not just monetary policy. A number of factors are supporting a decline in inflation, as I mentioned. Fiscal policy will providing significantly less of an impulse to growth. We do expect this year, although we do expect now that it will come slower than we had expected and hoped, that there will be relief on the supply side. So that, too, should lower these supply side barriers, which are a big part of the story why inflation is high. In addition, monetary policy will be becoming significantly less accommodative. So the question is, we'll be asking this question all year long, and that will be, are things turning out as we expect? There's a case that for whatever reason the economy slows more and inflation slows more than expected. We'll react to that. If instead we see inflation at a higher level or a more persistent level, then we'll react to that. And again, we're well aware that this is a different economy than existed during the last tightening cycle, and our policy is going to reflect those differences.
Thank you.
Thank you. Let's go to Gina Smialek. Let's go to Gina. Okay, let's go to Steve Leisman.
Thank you, Mr. Thank you, Mr. Chairman. Mr. Chairman, I have one sort of technical question and one question on principle. The technical question is, if you're going to discuss balance sheet at next upcoming meetings and you won't begin balance sheet reduction until after you begin rate hikes, it seems to technically mean that you won't or can't begin balance sheet reduction until the summer. Is that correct? That's the first thing. Second of all, you suggested that the with balance sheet running in the background, that you would possibly be raising rates and running off the balance sheet at the same time. That's sort of the technical question part of it. The principal question I have is, you said it's going to be running in the background, but the statement on balance sheet principle says the committee is prepared to adjust any of the details of its approach based on economic and financial developments, which suggests there's something of a reaction function associated to the balance sheet, and it won't be running in the background. So could you give us any a sense of the discussion or staff presentation on what is the reaction function surrounding the balance sheet? Thanks.
So let me start by talking about that last paragraph. So you'll remember during the last cycle that this process of building up and then shrinking the balance sheet is a complicated one, and it involves inevitably surprises. And so during the prior cycle, we amended our balance sheet principles a number of times. Now, we didn't intend to do that. Events required us to do so. So we got a pretty robust paragraph there that says we're free to do this at any time. And it doesn't mean we're going to, but if the situation turns out to be different than we had thought, we're not going to stick with something that isn't working. That's all that's saying. It's meant to be quite a general statement rather than a hint. So, I mean, I like to think that our philosophy of the balance sheet is embodied in these principles. So, the idea that, for example, the federal funds rate is the primary means of adjusting the stance of policy, that will determine the timing and pace of reducing the size of the balance sheet to foster the dual mandate, that will begin to reduce the size after we begin the process of raising rates, and on like that. I mean, those are all the things that try to describe how we will proceed. But it may be at a higher level, to try to get at your question. Asset purchases were enormously important at the beginning of the recovery in terms of restoring market function, as they were right after in the critical phase of the global financial crisis. And then after, they were a macroeconomic tool to support demand. And now the economy no longer needs this highly accommodative policy that we put in place. So it's time to stop asset purchases first, and then at the appropriate time, start to shrink the balance sheet. Now, the balance sheet is substantially larger than it needs to be. We've identified the end state as in amounts needed to implement monetary policy efficiently, effectively in the ample reserves regime. So there's a substantial amount of shrinkage in the balance sheet to be done. That's going to take some time. We want that process to be orderly and predictable. And so those are some of the ways I would think this lays out our, the way we're thinking about this. In terms of the timing, I can't really help you. It just says after we get underway. So I would say we're going to have another discussion at the next meeting, and my guess is we'll have at least one other discussion at the meeting after that, and we'll tell you as we make progress, and we'll start the process of allowing runoff and shrinking the balance sheet at what we find to be the appropriate time. I wish I could say more, but honestly, we haven't made those decisions, and we actually haven't even really had the important discussions on a lot of the details that we will have at coming meetings.
Thank you. Let's go to Craig Torres.
Chair Powell. Chair Powell, good afternoon, Michelle, and Chair Powell, Craig Torres from Bloomberg. Chair Powell, at the beginning of the conversation, you said risks are two-sided. And I'm wondering if you can elaborate on what are the risks to the elusive soft landing? Is Fed policy a risk, over tightening, or what are the risks? And then second, Chair Powell, I have a quick administrative question. Robert Kaplan's disclosure of his securities transactions. In a couple months, Chair Powell, or maybe sooner, you and I will file our tax returns and we'll list transactions and all kinds of things. And next to those transactions, we'll put dates. And Bloomberg asked for the dates of Mr. Kaplan's transactions. The Dallas Fed is not giving us the dates. And I don't see why this is a matter for the Inspector General or anybody else. I mean, why can't he give us the dates? Will you help us get the dates of those transactions? Thanks.
So you asked about the risks first. So, the one risk is that inflation risks are still to the upside in the views of most FOMC participants, and certainly in my view as well. There's a risk that the high inflation we're seeing will be prolonged, and there's a risk that it will move even higher. So, and we don't think that's the base case, but you ask what the risks are, and we have to be in a position with our monetary policy to address all of the plausible outcomes, and that calls for us to be in position. We have an expectation about the way the economy is going to be evolved, but we've got to be in a position to address different outcomes, including the one where inflation remains higher. And of course, that is a risk to the expansion. You know, we've been saying that what we need here is another long expansion, which is the kind of thing we saw over the last, which is the record long expansion. We saw labor force participation rise. We saw wages persistently higher for people at the lower end, and there really was no obvious imbalance in the economy that threatened that expansion. It could have gone on for years were it not hit by the pandemic. So we'd love to find a way to get back to that. That's going to require price stability, and that's going to require the Fed to tighten interest rate policy and do our part in getting inflation back down to our 2% goal. So I mentioned two-sided risks. You know, a couple things. One, the COVID is not over, and COVID can continue to evolve, and it's just we have to accept that it's not over, and the risks to it can slow down growth, and that's sort of a downside risk from a growth standpoint. I would point to, you know, another risk is just further problems in the supply chains, which could slow down activity. And you see the situation in China as a situation there where that's their no COVID policy may cause more lockdowns, is likely to, and that may play into more problems in supply chains. In addition, there's what's going on in Eastern Europe and things like that. So there's plenty of risk out there, and we can't forget that there are risks on both sides. So that's there. That's what I would say. I know you've been all over this issue with my colleagues, Craig, on the issue of information. We don't have that information at the board, and I asked the Inspector General to do an investigation, and that is out of my hands. I am playing no role in it. I seek to play no role in it, and I can't help you here today on this issue, and I'm sorry I can't.
Okay.
Thank you. We'll go to Gina now.
Thanks for taking our questions, Chair Powell, and sorry for my tech issues. I wonder if you could tell us a little bit about where your thinking on inflation stands today. You know, the last time we saw an SEP back in September, we saw that you and your colleagues were projecting that inflation would sort of sink back down quite close to target by the end of the year. And I wonder if you still think that projection from December is a reasonable one, and if your thinking has changed at all, I wonder how you're thinking about that. And I also wonder if you could talk a little bit about the pathway to getting to that deceleration. Like how do we get from here, 7% CPI, to where you expect to be at the end of the year?
So I'd say, since the December meeting, I would say that the inflation situation is about the same, but probably slightly worse. I'd be inclined to raise my own estimate of 2022 core PCE inflation. Let's just go with that by a few tenths today. But we're not writing down an SEP at this meeting, but I think it hasn't gotten better. It's probably gotten just a bit worse, and that's been the pattern. So I think if you look at the FOMC participants, there's a range there, and that range has been moving to the right for a year now. And by the way, if you look at other forecasters, essentially all other macro forecasters who do this for a living, you've seen the same pattern. So what do we think about that? Well, I think we wrote down rate increases in the December meetings, each of us individually. And I think to the extent the situation deteriorates further, our policy will have to address that. If it deteriorates meaningfully further, either in the time dimension or in the size of the inflation dimension. So that's how we're thinking about it. As I mentioned, though, I think part of this will be that the Fed, moving away from a very highly accommodative policy to a substantially less accommodative policy, and then over time to a policy that's not accommodative in time. I don't know when that will be. Those are the things that we're thinking about. That's part of it. Another part of it is that fiscal policy provided an impulse to growth over the last 2 years. That impulse will be less. In fact, will be negative this year. And so that's another thing. The other one is we will eventually get relief on the supply side. And, the ports will be cleared up, and there will be semiconductors and things like that. Now, what we're learning is it's just taking much longer. So I think longer than expected. And that, I think, does raise the risk that that high inflation will be more persistent. I do think we'll come off of the highs that we saw in the early part of this episode in the spring last year. But really, the question is going to be what is inflation running at, and so we'll be watching that. And our objective is to get inflation back down to 2%. It's also to provide enough support to keep the labor market healthy. The labor market is very, very strong right now. And I think that strength will continue. There's really a shortage of workers. We see it particularly among production and non-supervisory workers and people in the lowest quartile. You see very large wage increases. I mentioned some of the other indicators. So I think that's what we're looking at. And we're also, we realize, I think, as everyone does, that this outlook is quite uncertain and that we're going to have to adapt. And we're going to communicate as clearly as we can, but we're going to have to be adaptable and, move as appropriate.
Great, thank you. Thank you. Let's go to Colby Smith.
Thank you, Michelle. Chair Powell, when you talk about being humble and nimble about the path forward for monetary policy, does that also include the possibility of raising interest rates by larger increments and, say, doing a 50 basis points hike at some point if inflation does not moderate sufficiently? And should we interpret this approach as a departure from the gradual pace that we saw during the last hiking cycle?
So, as I mentioned, we have not made these decisions. We really haven't. And what I can tell you now, though, is that we fully appreciate that this is a different situation. If you look back to where we were in 2015, 16, 17, 18, when we were raising rates, inflation was very close to 2%, even below 2%. Unemployment was not at our estimates of the natural rate, and growth was, in the 2 to 3% range. Right now, we have inflation running substantially above 2%, and more persistently than we would like. We have growth even in forecasts, even in the somewhat reduced forecasts for 2022. We still see growth substantially higher than what we estimate to be the potential growth rate. And we see a labor market where, by so many measures, it is historically tight. I think in a way, the least tight aspect of it is looking at the unemployment rate, which is still below our median estimate of maximum employment. But if you look at things like quits and job openings, as I mentioned earlier, and wages, you're seeing, and just the ratio of job openings to unemployed, you're seeing a very, very tight labor market. Now, we also know that labor force participation is significantly lower. It's 1.5 percentage points lower than it was in February of 2020. Maybe 1 percentage point of that is retirements. Some part of those retirements are related to COVID rather than just regular retirements. So we think there is a pool of people out there who could come back into the labor force, but it's not happening very quickly, and it may continue to not happen very quickly as long as the pandemic is on. So that's how we think about that. We haven't made, to your specific question, we really have not addressed those questions, and we'll begin to address them as we move into the March meeting and meetings after that.
Let's go to Rachel.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm wondering if you can talk to us about any metrics that the Fed uses to assess how inflation affects different groups of Americans, especially lower income earners. And are you worried that the Fed underestimates or can't effectively measure the impact of inflation on some of the most vulnerable households? Thank you.
So it's more a matter of, I think the problem that we're talking about here is really that people who are on fixed incomes who are living paycheck to paycheck, they're spending most or all of what they're earning on food, gasoline, rent, heating, things like that, basic necessities. And So inflation right away forces people like that to make very difficult decisions. So that's really the point. I'm not aware of, inflation literally falling more on different socioeconomic groups. That's not the point. The point is some people are just really prone to suffer more. I mean, for people who are economically well off, inflation isn't good. It's bad. High inflation is bad, but they're going to be able to continue to eat and keep their homes and drive their cars and things like that. It's more so that's really how I think of it. And we have to control inflation for the benefit of all Americans. But part of it is just that it's particularly hard on people with fixed incomes and low incomes who spend most of their income on necessities, which are experiencing high inflation now.
Thank you. Let's go to Edward Lawrence.
Thanks, Michelle, and thank you, Mr. Chairman, for taking the question here. So year over year, inflation's at a 40-year high. The input costs for producer price index for all of 2021 was the highest on record. Some investors fear that the Fed might be moving too late. Now, you said no decisions were made on the path of rate hikes, but was a rate hike more than 25 basis points discussed today? And as a follow to that, because I have problems with the mute button, as a follow to that, you testified that the supply chain issues could be worked out by the end of the year. You talked about that today. The CEO of Ford, though, told Fox Business today that the chip shortage will last into 2023. So today you said inflation will start to ease this year. I want to drill down and get a timeline that you see as to when we could see that relief. Thank you.
So I would not say that I would expect the supply chain issues to be completely worked out by the end of this year. I do not expect them, and I have not expected them. What I would say, and I have been saying, is that I expect progress to be made in the second half of this year, mainly. Progress, because we're not making much progress. If you look at a ton of metrics, you can find some that suggest that delivery times are shorter and inventories in some industries moving up. But overall, we're not making progress. And things like the semiconductor issue they're going to be quite a long time. I would think they'll go more than through 2023. In terms of being too late, I would just say this: our policy needs to be positioned to address the full range of plausible outcomes, as I said, and particularly the possibility that inflation will continue to run higher more persistently than we'd expected. And we think we are positioned to make the changes in our policy to do that, and we're committed to doing that. And that's really where we are. In terms of your question about the size of rate increases, we haven't faced those decisions. We haven't made them. It isn't possible to sit down here today and tell you with any confidence what the precise path will be. But as we work our way through this meeting by meeting, we are aware that this is a very different expansion, as I've said a couple times, with higher inflation, higher growth, a much stronger economy. And I think those differences are likely to be reflected in the policy that we implement.
Thank you. Let's go to Mike McKee.
Thank you, Mr. Chairman. I'd like to sort of weave some of the strands of your answers together and ask you, as you start to reverse policy, what your goal is. Are you going to be raising interest rates until you get inflation to 2%? Do you want to go below 2% so that on average you get a 2% inflation rate? And because you said we have to protect the employment part of your mandate, is there some sort of circuit breaker that would stop you from raising interest rates on the employment side?
So no, there's nothing in our framework about having inflation run below 2%. So that we would do that, try to achieve that outcome. So the answer to that is no. What we're trying to do is keep inflation expectations well anchored at 2%. That's always the ultimate goal, and we do that in the service of having inflation. We get to that goal by having inflation average 2% over time. And if inflation doesn't average 2% over time, then it's not clear why inflation expectations would be anchored at 2%. So that's the way we think about that. You know, what was the last part of your question?
I was asking if you're protecting the employment side of the mandate, whether there's some sort of circuit breaker there.
Nothing like that. I mean, I would say you have a tremendously strong labor market, and you have growth this year at forecast to be well above potential. I mean, people are forecasting growth. If you think potential growth is around 2, most forecasts are significantly above that for 2022. And that's even with policy becoming substantially less accommodative. So the labor market's going to be strong for some time. Ideally, what we're trying to achieve is inflation getting back down to 2%, and we're trying to do that in a process that accomplishes, that will also leave the labor market in a very strong position. And no one really knows what that will take. Again, I would say that it isn't just monetary policy that's helping inflation get down. It'll be supply side improvements, and it'll be less fiscal impulse in all likelihood. So, but monetary policy will do our job. It is our job to get inflation down to 2%, and a situation where the two goals can be in tension is a difficult one. But I don't really think they are here, though, because I think a really significant threat to further strengthening in the labor market in the form of higher participation over time is high inflation. And also, high inflation is taking away the benefits of some of these large wage increases that we're seeing now. So we do hope to achieve, and our plan is to achieve both of those goals.
If I could follow up, does the danger of tightening too much as policy works its way into the economy with a lag mean that you should go back to being more forecast dependent in making decisions rather than the state dependency you've been using as a framework for the last year and a half or so?
State dependency was particularly around the thought that if we saw a very strong labor market, we would wait to see actual inflation before we tightened. And so that was a very state-dependent thought, because for a long time we'd been tightening on the expectation of high inflation, which never appeared. And that was the case for a number of years. So in this particular situation, we will be clearly monitoring incoming data as well as the evolving outlook.
Let's go to Michael Derby.
Thank you for taking my question. I want to ask you, with the benefit of hindsight, and I realize, I mean, that is what it is, but do you feel that, monetary policy and fiscal policy maybe did too much to react to the crisis, and that part of the inflation problem that we're having right now is because the government response, collectively was more than what the economy ended up needing?
So I think it's too soon to write that history, really. But what I would say is this. If you remember what it felt like at the beginning of the pandemic, literally the global economy shutting down in large part, including our own economy, and people going to their homes for weeks on end in masks, and there are no vaccines, and it could be a really long time to get them, and you have economic activity drops by a shocking amount in one quarter. So there was a real risk of lasting damage. And I think Congress responded remarkably with the CARES Act, incredibly timely, very powerful. There'll always be flaws in these things, but in real time, it was a remarkable achievement. And we responded, and what we were able to do was, stave off a collapse of the financial system at the beginning and make time for what really needed to happen, which was the income replacement and then the recovery that Congress enabled with the CARES Act. So now that was a lot. And what we did was a lot. And, now, what we have now is we have the strongest recovery of any country, and we have a recovery that looks completely unlike other recoveries that we've had, because we've put so much support behind the recovery. And we're managing the relatively high-class problems that come with that, which are high inflation and a labor shortage. So, and these are serious problems, very serious problems that we're working as hard as we can on. Was it too much? Again, I'm going to leave that to the historians. But look, in 25 years, we'll look back at this incident, which will be a 2, 3, 4, 5-year period, and we'll say, we'll have a much better basis to make a judgment about the actions that people took. But it was all founded, though, in a very strong reaction to a unique historical event. And I guess I'll have to leave it at that. I hope I'll be around to see how that looks in 25 years.
Fair enough. Thank you.
Thank you. Let's go to Jean Young.
Thanks, Michelle. Chair Powell, some investors are expecting the yield curve could flatten or even invert after rate hikes begin. Would that worry you? And how important is that risk in the Fed's consideration for adjusting policy?
So we do monitor the slope of the yield curve, but we don't control the slope of the yield curve. Many factors influence longer-term interest rates. But it is something that we watch, and you will know that from when we had this issue a few years ago. And we take it into account along with many other financial conditions as we try to assess the implications of all those conditions for the economic outlook. So that's one thing I would say. Another is currently you've got a slope, if you think about 2s to 10s, 2-year Treasury to 10-year Treasury, I think that's around 75 basis points. That's well within the range of a normal yield curve slope. So it's something we're monitoring. We don't think of it as, I don't think of it as some kind of an iron law, but we do look at it and try to understand the implications and what it's telling us. And but it's one of many things that we monitor.
Can I follow up real quick and ask if it did invert, would you tie it to U.S. fundamentals, or would it be driven by a much broader set of factors?
That's a good question in real time. Obviously, U.S. long-term sovereign debt is an important global asset, and the fact that our rates are so much higher than other risk-free sovereign rates around the world may put something of a ceiling on our rates. I don't know, but it would really depend on the facts and circumstances at that time.
Thank you. Let's go to Brian Chung for the last question.
Hi, Chairman Powell. Brian Chung, Yahoo Finance. Within the context of just the broad effort to normalize rates, would you describe what you want to do as a gradual hiking? And then secondly, within the context of hiking cycles, it's often the talking point for financial stability and wanting to make sure that asset bubbles don't merge. Is that something that has also factored into the conversation as you start to think about hiking rates? Thanks.
I would describe what we're doing along these lines. This is going to be a year in which we move steadily away from the very highly accommodative monetary policy that we put in place to deal with the economic effects of the pandemic. And that's going to involve a number of things. It's going to involve, and it does involve, finishing asset purchases. It's going to involve lifting off, and it's going to involve additional rate increases as appropriate. And we're going to write down in March our next assessment of what that might be. It's going to continue to evolve as the data evolve. We need to be quite adaptable, I think, in our understanding of this. The last thing we're going to do is we're going to have a couple more meetings, I think, to talk about allowing the balance sheet to begin to run off and do so in a predictable manner. And that's something that we will also be doing as appropriate. And I wouldn't, I don't think it's possible to say exactly how this is going to go, and we're going to need to be, as I've mentioned, nimble about this. And the economy is quite different this time. I've said this several times now. The economy is quite different. It's stronger. Inflation is higher. The labor market is much stronger than it was, and growth is above trend even this year, let alone last year. So all of those things are going to go into our thinking as we make monetary policy. And you asked about financials to have concerns. In connection with our policy, was that your question?
Yeah, within the context of other hiking cycles, it seems like worries about asset bubbles emerging as a result of easy rates has been part of that. I didn't know if that was part of the discussion today.
I would just say this. We, of course, have a financial stability framework. And what it shows is a number of positive aspects of financial stability. But you mentioned really asset prices is one of the four. So asset prices are somewhat elevated, and they reflect a high risk appetite and that sort of thing. I don't really think asset prices themselves represent a significant threat to financial stability, and that's because households are in good shape financially than they have been. Businesses are in good shape financially. Defaults on business loans are low and that kind of thing. The banks are highly capitalized with high liquidity and quite resilient and strong. There are some concerns in the non-bank financial sector still around money market funds, although the SEC has made some very positive proposals there. And we also saw some things in the Treasury market during the acute phase of the crisis, which we're looking at ways to address. But overall, the financial stability vulnerabilities are manageable, I would say.
Thank you very much.
Thank you.
That was the end of the press conference there with Fed Chair Jay Powell. What a roller coaster ride once again we're having with the markets. The statement was interpreted as dovish, the press conference as hawkish, stocks like the former but not the latter. And we've gone from session highs pretty much plus 500 on the Dow to session lows, currently down almost 400. Welcome to the closing bell, everyone. Crazy intraday moves once again, but Sarah, sadly today in the wrong direction.
No, and another 800-point swing in the Dow, which is really what we've seen in the last few days. The interpretation of what Fed